Well, guys, we have a lot to discuss. A US-UK trade deal, the potential start of many, and changes to the Semiconductors Act. But possibly even bigger than all of this is the level we continue to reject on the charts. Why does it matter, and what could Wall Street be looking at? As US yields spike and the dollar starts to break out to the upside once again, it looks like there are some dark pool trades going on in the VIX. Could volatility be about to spike once again? And are market players starting to hedge against the world economies? Bitcoin goes ballistic into its next resistance zone. But if it gets through here, what are we looking at? Stocks, commodities, and cryptos, a lot to get into. Let's do this right now together. Well, welcome back everyone to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the big data that we've been looking at, the UK-US trade deal, and of course, the key levels coming your way. But let's kick things off together by discussing this trade deal in its entirety. There were really four main points when you have a look at it on the surface, and you do need to remember that in terms of US goods trade balances with major partners, the UK is number 2 in terms of a natural overall surplus. The market will ultimately be looking at these bottom ones here. And we did actually see Trump trying to potentially juice the market a little bit into negotiations with China, as he said he might be willing to lower tariffs to around 50% potentially before even negotiating anything itself. These are, of course, positive signs, but let's just go through this US-UK trade deal. According to Grok, the big things here were reducing US tariffs on UK autos 27 to 10, overall lowering UK tariffs on US goods from 5.1 to 1.8%, and ethanol from 19% to 0. The other one was, of course, opening up a tariff-free US beef quota, but the problem with that one is that it still needs to meet the UK standards, and as far as I know, that could be a contentious subject there. Including UK purchase of $10 billion, at least in face value, on Boeing aircraft. And in general, that was pretty much the main kind of factors that we found out over the announcement. There are more things, I'm sure, coming over the next few weeks, but they are to be hashed out. So on the surface, what do you think? Is this a good deal? Is it a bad deal? Is it a step in the right direction? Well, Wall Street, of course, took it as a potential step in the right direction, at least at first. But what you may have noticed throughout the session is we saw a lot of spikes in yields. In fact, every single one of the major treasury yields was up across the board, and that's not really solving one of Trump's big problems, which is, of course, debt maturity later on in 2025. Yes, the US has a ton of debt maturity coming this year that's not often discussed, and as you guys know, 5% is the magic number on the US 30-year. Continue to set 4.95 as a major alert. Now, when it comes to what retail has been up to, this could come into play as we consider the charts later on today's session. For 11 straight weeks, let me repeat that, 11 straight weeks, retail traders have been incredibly bearish, at least in the sentiment reports. Now, you could claim that this could be political bias or something else that's going on from many investors, but in general, 11 weeks is the type of thing that you usually see during global financial absolute meltdowns. Well, that's not exactly what we've just had recently. Yes, we've sold off almost 20%, but we haven't actually seen an overall meltdown like some of these other bigger selling periods. So what gives? Well, it turns out that everybody might be saying that they're bearish, but as we've already seen now, records are being made in terms of private clients, that is mostly us retail traders, actually purchasing up. According to Bank of America's latest data, this is up-to-date data, this is the longest private client buying streak in their data history ever. Wow. Okay, so it means that literally they have never purchased at a higher level. We have never purchased more, never purchased in more aggression, and we have never been conditioned to buy the dip at any point in time more than it has done so now. So could it be that cracks are starting to appear? Well, as we already know, according to institutional clients, they've been selling into the rip here from retail. But who's having the last laugh right now? I wouldn't worry about hedge funds, but I would say that retail is currently feeling pretty good. And there's been a bit of a shift over the last couple of sessions with some traps, particularly over the last 24 hours, making a lot of people very bullish. This is the type of area you need to be neutral, possibly even bearish, possibly very, very cautious at, because it's that type of time where we find the charts are starting to build confluence with a very important level. Now, when we have a correction like we did, and some people are calling it a bear market, some people are saying that it just didn't quite tick that bear market category, do we generally see bullish attitudes once we've started to correct well over 50%? Well, as it turns out, when we hit these levels, usually 12 months and 6 months later, markets are up big time. And these are the types of stats that get a lot of people excited. They get people to go towards the buy the dip. And obviously, we've seen Zweig breadth thrusts and many other bullish signs across the board. In terms of rate cuts, it doesn't look like, according to Jerome Powell and the Federal Reserve this week, that we're getting a rate cut anytime soon. But as you guys can see here, this is an update from Charlie Bilello over on X. And you can see here that we have a whole bunch of lower readings across the board here from several central banks. But imagine if you were in Turkey, the central bank rate there is 46%. Wow. 46%. That is absolutely wild. Out of control inflation, I guess. NASDAQ composite versus the current and old kind of runs. These are when you take a look at the 1995 run versus the 2022 bull run. We are at that point of course, recovery. And in this case, if we're not looking at the 98 narrative, which of course we'll do in just a moment, then you actually didn't see a doubling bottom like in 1998, because effectively that's that point there. And we actually just saw a dull market. So as it came back to the previous resistance, we saw a dulling market that slowly ground its way up over time. Now, if that's how it's going to be, and I don't think it will be, but let's just say that is how it's going to be, it's going to make it very difficult to get any proper drops in and will frustrate a lot of people. In essence, that is a V-shaped recovery. So do you think we're going for a V-shape? Do you think we're going for a doubling bottom or more of a deeper pullback to fill those gaps? Let me know in the comments down below. Always interested to see your opinions, guys. So what's the good news? Well, one of the best pieces of news right now is that we are seeing leadership from infotech and semiconductors. Now, generally speaking, when you get XLK, when you get SMH recovering and they're starting to outperform, that is a great sign towards a real bullish recovery. And the main key here is to actually hold up throughout the next kind of 40 days. Now, we're about here off the lows, so we've seen a very, very nice data run so far, but we do want usually to see infotech, that is all of the technology stocks and particularly semiconductors, to continue to come up. Now, we did get some changes to the Semiconductors Act in terms of allowing possibly companies to actually sell more chips, which is obviously a net positive across the board. And that has people also feeling like semis could outperform over the next coming weeks and months. According to the new used vehicle, not new, but used vehicle index, you can see that's actually spiking up as well. And this is a direct representation of what we've seen in terms of tariffs. Now, why does this happen? Well, just remember, I'm going to read this out again. Tariffs are a tax. We know this. And taxes raise prices over the short term and can basically be looked at as inflation. This has a lot of people freaked out, so they're constantly buying cars right now because they're concerned about the costs of cars in the future, potentially rightfully so. And ultimately, that will lead to higher prices on cars and lower demand overall, which generally creates deflation. Now, this is the way it's always worked in the past, and that deflation has potentially turned into a recession. But to remember, it takes time. In fact, it's taken up to 1 to 2 years to play out through systems correctly. So, yeah, when you hear about tariffs, the reason the market was down was, justified. But if we continue to see the tariffs sticking on and we don't see any real changes to some of the major ones, and especially the major trade partners, that could be a mega issue long term and could take us down the path of a recession. When we're talking about here, the Qs, we're talking about dark pools, we're still actually trading around these same zones. So even with all of this news about the UK, we're kind of still trading around the main key level here for Microsoft. We're still trading around the main key level for the Qs. And we did just see what looks to be a short VIX close. That is that someone that has actually gone in with a sweep, which means that it's a faster transaction, one that needs to be done in as quick as possible, basically. That has just been closed, we have to assume, over the last 24 hours. So basically, we just saw somebody most likely close their overall short VIX position. Could that be a bit of a sign of the VIX bottoming for now? Now, do we still live up to the 98 narrative? Is this still the kind of way we're facing it? Well, we're basically here at this point, and we're facing off against the major supply on the charts. And as you guys would know, the major supply is acting like a little bit of a resistance, and it's that 200-day moving average on the NASDAQ that particularly seems to be rejecting the most. It's probably the big indicator that we're looking at. For bulls, wake, breadth, thrust, we've talked about this every day for 2-3 weeks now. So obviously, just so you can see the stats there for any new viewers. And gold-silver ratio remains kind of stuck in this over kind of sold zone for silver. So basically, silver still being cheaper than gold, although both didn't perform that well as the dollar broke out over the last 24 hours. Let's now jump into the charts. Central banks were injecting some liquidity over the last couple of days. So, of course, that needs to be taken into consideration. And you can see here, even with the big news, the S&P actually did manage to make a new high on the real market, that is during normal open, but it wasn't able to break through that all-important 5780 zone to really get that higher high. And you've got to remember, this is now potentially open as the market is still in an upward trend. We need to, really say that because we haven't seen the lower low. We'll talk about the lower low in a moment. So at this stage, could we wipe this high? Could we get as high as like a 58 something? It's certainly possible, although we are seeing signs of exhaustion across the board. And even with these bits of news, these deals that aren't even necessarily fully fleshed out yet, we're just not getting that huge absolute push through get past these resistance levels. Let's now take a look at the overall futures action. You guys know 55.75 closed below there, very bearish for the market, and that's going to change from being a series of higher highs and higher lows, like it has been so far, to a lower low and potentially then the bears being involved. For now, though, the markets are still considering the upside in terms of what's going on. Here are the updated options high and low levels. And obviously the big thing here is going to come back to the options. So let's take a look now at the options and see what everybody is doing. And it was overwhelmingly a call session with everyone stacking calls for the next session at 5680 current resistance to 5700 zone, and basically breaking it down with less puts overall. The 5600 now remains as the put wall, and the 5700.
Paychex Inc. announced a 10.2% increase in its quarterly dividend to $1.08 per share, reflecting strong financial health. The company reported $5.28 billion in revenue for fiscal 2024, a 5% increase year over year with a net income of $1.69 billion. Paychex's robust cash flow and disciplined capital allocation support its shareholder-friendly policies, making it a high-quality investment. NVIDIA is modifying its H20 Al chip for the Chinese market following U.S. export restrictions. The downgraded chip aims to maintain market presence despite potential revenue losses of $5.5 billion. Analysts remain optimistic about NVIDIA's long-term prospects, with a strong buy consensus rating. Walmart is ramping up imports from India, nearly doubling shipments of household goods and clothing to navigate U.S. tariffs on competitors like Bangladesh and China. The company emphasizes its diverse sourcing strategy from over 70 countries,